Hello and welcome to the Investment Markets podcast, where we aim to discuss investment matters that impact self-directed investors. I'm your host, Darren Connolly, CEO at Investment Markets, and today I'm delighted to be joined by Justin Lin, investment strategist at Global X. Today we're going to discuss commodities investing. But before we get into it, I need to remind you that this is general advice and general information only. Nothing in this podcast should be construed as an investment recommendation. As always, you will need to decide what is right for you. Welcome, Justin.
Thank you for having me.
It's a pleasure. Now, today we're going to talk about commodities investing. It's maybe not the first thing that people might consider when looking at their investment portfolio. So to start us off, I'd love for you to just give us a definition of the universe. What does commodities investing actually entail? And as an investor, how do I get exposure to it?
Yeah, absolutely. And I think that's a fantastic question because commodities investing is in and of itself a very, very broad discipline. So from our perspective, Global X ETFs, we are pretty well-known commodity house in Australia. Our marquee product is the GOLD Physical Gold Structured Fund. So that invests in physical, gold bullion. So that's already one way in which you can access, commodities such as gold, silver, and the like. So immediately physical commodity investing. And I think that is what a lot of investors think about intuitively when they think about commodity investing.
It's always on the ABC website.
Right. Yeah.
Or the ABC News when the queues go down.
Yeah, the queues on the bullion. Yeah, exactly. So when most investors think about commodity investing, they think about, buying the physical metal or the physical goods. But with a lot of commodities, that is not really viable. If you think about even industrial metals like copper, when you get into the millions of dollars of copper, you're starting to look at warehouses full of copper. So physical investing in terms of that starts to become a little bit untenable. And for investors who are interested into that space, they perhaps need to look towards mining equities. So we have the Global X Copper Miners ETF, which invests in a basket of global copper miners. And these miners, because they have very high revenue exposure to copper, do really reflect that copper price, and they have high correlation with the copper price movement. And they also benefit from a little bit of that operating leverage because their cost base roughly stays the same as the price of the metal goes up. So their profit margin just goes up. So that's yet another way, which is mining equities. And a lot of investors are familiar with that as well. And the final way is through futures. And this is perhaps the most complex, and a lot of investors get tripped up here. But futures are basically contracts with which you can enter into to perhaps attain the commodity at a future point in time. They're called futures. And here, a lot of investors get a little bit tripped up because you have to deal with other concepts like contango or backwardation, and that starts to mess up with your returns. So for more expert investors, we think futures perhaps for you, but in terms of usual, everyday retail investors, very much we like to stick in the physical and the mining equity space.
And it's minerals or things that people are actually probably pretty familiar with in the day-to-day life.
Yes. Sorry. If you're talking about strictly what commodities are, it's everything spanning from industrial metals to precious metals to energy. So like crude oil, natural gases. And then it can get into really nebulous things like lean hog or livestock, or even soft commodities like grains and cocoa and coffee beans and whatnot.
Okay. I think the hog is probably probably one of the more extreme examples.
Yes.
So let's not go pursuing the dynamics of the pig or the hog market. Yeah. Now, but things that are sort of forefront of everybody's minds is oil, gas, copper is a very good one, given the sort of the AI boom. It's these commodities are very much there front and center of the news cycle nearly every day in a way that they perhaps weren't a couple of years ago. So with all of this, I wouldn't necessarily say hype, but with them being so prevalent in the media, Are we at the forefront of some kind of new commodities super cycle?
Yeah.
What's actually happening in markets today?
I think that's a fantastic question. And I don't want to jump the gun, but I also want to jump the gun and say, yes, I think we are at the beginning of a super cycle. But to really explain why I'm so bullish on commodities right now, I think we have to go back in time and understand that when you stretch out the time horizon, commodities haven't actually done very, very well. So if you look at where commodities are today, they are still 20% below the peaks that we saw pre-GFC, so in 2007, 2008. And that's against equities, which have more than tripled over the same time period. So clearly commodities have been an underperforming asset, at least for the past 10, 20 years or so.
So
And
cyclical.
yeah, so cyclical, but also I think there were some structural problems that were underneath the commodities market that a lot of investors aren't aware of, which is,
For example,
for example, when China joined the WTO in the early 2000s and India was also up and coming as this emerging market force, there was this massive demand by traders all around the world that these huge populations would have massive demand for infrastructure needs as well as consumer goods. So these are things that obviously are made up of commodities. And so they bid up commodities in a way that was perhaps unsustainable. And that demand actually didn't materialize to the same extent that a lot of traders were expecting post GFC. And then on the supply side, because they had seen or they were expecting this wave of demand to come at them, they had built out these massive supply chains, expanded mines, bought livestock, and expanded their farmland. And suddenly they were met with a reality where demand wasn't really up to par. So we had both less demand than expected and more production than expected. So that's the environment in which where we sat perhaps for the past 20 years.
So it came back to the old supply and demand
Exactly.
dynamic
It's
again?
always supply and demand in commodity space. And then now things are a little bit different because if you are in a very globalized rule-based economy, then yes, in terms of getting commodities from one place to another, it's pretty much a matter of commerce. I sign a contract, I wait for the asset to arrive at my door. But now, if you're looking at many commodities, particularly critical commodities like copper, rare earth elements and stuff like that, you're running into trade sanctions, you're running into export controls. And of course, there's wars like Iran, as well as Russia, Ukraine, that are impacting the flow of goods as well. So
it's geopolitics is starting to play
exactly
a role in the supply and demand?
Yeah, for sure. And so from that perspective, supply that is overseas or external is no longer as reliable as it was over the past 10 years. So investors immediately have to kind of reprice for that risk premium that didn't exist before. And they start to look at ways which they can perhaps invest and bring that supply domestically or friendshoring to make sure that they have that security for these commodities. So from the supply side, we are in a very different picture than we were perhaps 10, 15 years ago, where everything was plentiful, everything was connected, and everybody was very, very happy, and prices were low.
Better times.
Exactly, better times. Better times now for commodities, but better times then for the average person. And so that's the supply side of the picture that we have kind of semi-addressed. And then on the demand side, we're starting to see multiple megatrends in terms of technologies like AI, for example. And AI, I really highlight that because that's something that everybody's talking about from a software and hardware lens. But from my perspective, and what I think is really, really interesting, is that it's perhaps the biggest commodity megatrend of all time. Is if you just hone into just one thing that we know about AI, is that it has very high energy demand. So immediately you're thinking higher crude oil usage, higher natural gas usage. And then to take on that high electric load in terms of the grid, you have to upgrade the grid infrastructure. So copper, aluminium, steel. And then beyond that, we're thinking about clean energy stacks, perhaps solar energy, wind energy, or even hydro to power these AI data centers. And with each of these, you have different commodity demands as well. So the point is AI by itself, and not talking about even other megatrends that are currently ongoing, like EVs or clean energy, is lifting demand across that entire commodities complex. And I think with that in mind, now we have demand on the uptick and supply less certain than ever. We are really entering that commodity super cycle that you talked about.
Yep. And you touched on it a little bit as well. It's not the only thematic that's ongoing. So if we just look at the AI boom and say this is kicking commodities up to the next level, we've got these other drivers that are there as well at the same time. So how are they just turbocharging it even further? Do they have a different role? Or are the different commodities being pumped up by these clean energy, energy transition? Is that having a different impact, or is it just pushing everything harder?
I think it's a bit of both. If you look at the way that these thematics have started to trade and this way that a lot of investors have started to think about these megatrends, for example, EVs and batteries and clean energy, they are melding together into this super megatrend, for lack of a better word, where AI is dependent on battery technology, energy storage systems for the data centers. And AI uses clean energy because it doesn't want to rely on dirty energy to power itself. And EVs are also obviously connected to the grid infrastructure and connected to that clean energy story as well. So it is becoming this force multiplier where everything is coming into one, and it is forming this new economy that will have a more structural demand base for all of these commodities that we've been talking about. So yes, each of them have an incremental uptick in terms of commodity demand, but together I think that is the reason why we're so bullish on so many of these commodities heading over the next 10 to 15 years.
Yep. So maybe just sort of asking the bear question,
Sure.
just to sort of turn it around, and it's always good to look at the flip side.
Absolutely.
What could possibly sort of burst the bubble for that super cycle? Like, what are the possible risks that you will be looking at on a day-to-day basis and just keeping an eye on?
I think that's a valid question to be balanced. But I want to preface with the fact that earlier we were talking about if you stretch out that time horizon, commodities haven't really done that well. We're still 20% below their pre-GFC peaks, whereas equities have more than tripled. So really the margin of safety there is much larger than...
So it's just a deep value exercise.
Exactly. It's almost like a value exercise if you believe in such a thing in terms of commodities. But if you're talking about actual risks, I think when you think about commodities, you have to think about demand. And when you think about demand, you think about economic activity. So if we do head into a deep recession, whether that is triggered by high energy prices causing demand destruction, or if there is some sort of yield crunch, then yes, there will be a negative impact on commodities. In terms of that energy story, and if investors are particularly concerned about the Iran war perhaps triggering a stagflationary environment, I actually think that is one environment in which commodities can actually offer a bit of balance and safety, given that if there is an inflation story, commodities are the feedstock into CPI.
Yep.
So what better thing to be holding and be invested in to hedge yourself against that inflation than the commodities themselves. So
that's like the oil story that we're seeing in the news at the moment, and fertilizer and gas. Everything that people are blaming
yes.
for a higher inflationary environment, actually, if you happen to be an investor in those things, it's not necessarily a negative story.
Exactly. It could actually be a positive one. And it's very important that you highlighted the fertilizer story, because it's not just energy. It's an everything commodity story right now. And one of our ETFs, which is the Global X Bloomberg Commodity ETF, that invests in a basket of 27 different futures. So it basically has all of the futures that are relevant to inflation, including lean hogs, by the way, is in that basket. And it's got copper, it's got aluminium, which is in its of itself really a very interesting story due to the fact that a lot of aluminium is made in the Middle East, refined in the Middle East. And we've seen some of the refineries and industrial compounds obviously come under fire. And aluminium refineries have this special quality where if they are even paused for a moment, the aluminium hardens and then you have to basically rebuild the whole thing. So that's a different story, and we'll leave that for a different part of the conversation, or perhaps at another time. But The point is, what's happening in the Middle East is driving prices up very, very broadly. And I think investors shouldn't just think about it like, oh, it's an energy story. Once the Strait of Hormuz opens, oil will come back down and everything will be okay. Actually, no, the entire supply chain across the entire complex has been stressed, and there will be second order effects that we can't even foresee, and third order effects that we don't know about, that will start to spread and reverberate through that entire commodity complex.
So the ramifications for some of those dislocations
Yes.
are going to take multiple years to play through. So if you're an investor in the commodity space, and again, not a recommendation, but there's certainly opportunity there if you're sort of cognizant of the different commodities and the impacts of what's happening on all of them.
Yeah, absolutely. I think the strongest opportunities are, definitely the ones where we are seeing the supply chain disruption, the one where we're seeing a lot of concern around national security and domestic supply. And the ones that I would really hone in on are perhaps things like critical metals, rare earth elements, and things like that. Yeah.
So for the ETFs, and you've mentioned a few of them that sort of Global X have, how do you construct the ETF? So what commodity elements will sit within a particular structure? How do you arrive at that decision?
So actually, we have quite a simple job when it comes down to what we do as an ETF provider. So we try to look at the Australian market landscape, and we see what our investors really looking for and what they want targeted exposure to, that they don't really have clean ways to express conviction in the Australian market. So something like the copper miner ETF, which is Global X copper miners ETF under the ticker code WIRE, so wire. So that one has a revenue threshold, purity revenue threshold. So basically, we ensure that everything within the fund has a certain level of revenue exposure to copper. And we really want investors to basically get the best possible exposure across a very diversified basket, both globally, geographically, and market cap size, to the copper price. So even though the names are in there include BHP and Rio Tinto, which are some of the home names that we are very familiar with, it also has names like Freeport-McMoRan, which is one of the biggest copper miners in the world. Ivanhoe Mines, yet another big miner. So that way, investors are really getting a true to label exposure. So from that perspective, we just want to make sure that these funds have purity, make sure they are exposed to the actual theme that investors.
So the true to label?
Exactly, true to label.
Yeah.
And then when it comes down to the physical stuff, I think there's really no picking or choosing for us. We just want to make sure that investors really have the underlying physical exposure. So one thing that a lot of investors don't know about our GOLD fund, that the physical gold structured fund, is that you actually have entitlement to the underlying bullion. So if one day, for whatever reason, you really wanted to have physical bullion in your hand instead of our physical gold ETF, you could theoretically, give us a call and then say, could you please deliver the gold bars to my door? And there's obviously a delivery fee involved and a redemption fee, but that can be done because every single gold bar is actually stored in a vault by JP Morgan, which is our custodian, and tied to the investor's name. Obviously, the more reasonable way to do that is just to sell the fund on the ASX and then go to ABC Bullion or something like that.
I'm pretty sure there'll be somebody who will take you up on that.
It has happened. It has happened.
Oh, so it has happened already.
It is an interesting process, and it has happened once or twice. But usually we would just advise for the investor, just go on the brokerage, sell the ETF, and then it would save you, a few $1,000s.
There's always somebody out there who wants to test the process.
Exactly.
That always happened. So for investors who are interested in this space, how do you view commodities? Are they a growth investment? Are they diversification? Is it a satellite investment sitting around their core? How should they think about it within the context of a much wider portfolio?
Great question. And there's two distinct ways that I think about commodities. And there's actually two baskets of commodities that I would think about in different ways. So in terms of the first way, I would like to think about commodities in terms of it being a diversifier or an inflation hedge. And the asset classes here are really your precious metals like your gold and your silver, which have historically been very, very powerful inflation hedges over long periods of time. And it also has the upside of gold being a safe haven asset. So when equity markets are in a downturn, there's a tendency for gold to really do quite well.
Somebody's going to call you up.
Yeah, exactly. Well, in the past, there's the Iran war, and then where gold has done not very well, there's a whole explanation for that due to the fact that it is an energy war and inflation concerns leads to high interest rate concerns, which is something that has been negative for gold historically as well, due to the fact it's a non-yielding asset. But overall, if you look at it, since the end of Bretton Woods, so past 50, 60 years, it has had a very strong track record of really being a good a smoothener of volatility for portfolios. So something that you put maybe 2 to 3% of your portfolio into and then just never look at for the long term. And it will keep up with inflation, and it will occasionally provide you with a little bit of balance when there's a market drawdown. So that's that first basket.
Yep.
I would also put broad-based commodities into that basket. So if you have a diversified commodities basket like our BCOM ETF, the Bloomberg Commodity ETF. The second basket, and I think this has started to become a little bit more popular recently, is thinking about commodities as a more thematic-y and growthy exposure, and really trying to price in the amount of demand that will come in from the future into this commodity, specific commodity space.
And does the AI boom play a role in this?
Absolutely. And I think copper, once again, is one of those commodities that a lot of investors think about in this particular way. And I think to really highlight just how much copper will be needed in terms of this AI data center boom is that per gigawatt of AI data center capacity that we put online, you're looking at roughly 25,000 tons of copper. And that's a lot, but it's difficult to visualize for the average investor and average person overall. 25,000 tons, what does that mean? Well, the Statue of Liberty is roughly 30 tons of copper. And the Statue of Liberty has turned blue because it is all copper. And that's the patina effect of copper, rusting over time.
30
tons.
30.
Not 300, not 3,000, 30 tons.
Yeah, I was just getting the order of multiples right.
Exactly. So 800 Statue of Liberties per 1 gigawatt of AI data centers. So
do we mine that amount of copper globally?
Well, that's the concern, because when we look at projections of production perhaps out to 2035 and demand out to 2035, you're looking at a 6 million, 5 million ton deficit. And certainly I think that is untenable and unrealistic in the long term, as in that demand gap cannot be allowed to exist the way that it does. So the prices have to go up to incentivize the copper miners to build out more production and and make more of these assets generate more copper. So that is essentially the bull case for copper over the next multiple years. And copper is one of these thematic growthy options. Other one that I think about quite intuitively is the uranium story. And once again, that also has to do with clean energy. It has a little bit to do with AI as well, due to the fact that nuclear energy has 99% uptime, and that aligns very, very well with data centers.
Yeah, Australia doesn't like it.
Yeah, we don't like it, but the rest of the world does. And Australia, in the grand scheme of things, pretty small in the investment landscape.
You can say Australia doesn't matter.
Well, I do hope that we come around on the topic, and certainly I think a lot of the world views it as one of the most viable ways for us to head towards that low carbon net zero future.
And Australia has a lot of uranium reserves
too. Exactly. I think one of the biggest in the world.
Yeah.
Yeah.
So maybe another commodities example that you might have to hand, because we've talked about copper a lot, uranium you just mentioned. Is there anything else that sort of keeps you awake at night,
Yes.
thinking about supply and demand.
Definitely. And this one really keeps me awake at night. And that's the rare earth elements and critical metal story.
That we see in our phones.
Yeah, that we see in our phones, and more than that, it's in defense tech, we've seen robotics. And I think there is two things that a lot of investors are not really attuned to or keeping a keen eye on in terms of this space. Number one is a lot of investors are not truly aware of how concentrated, because we did get a little bit of a jolt last year when President Trump announced the Liberation Day tariffs on China. They did give us a little bit of a taste of the potential to block all of that rare earth elements and stopping them from being exported to the rest of the world. But they didn't really go through with that to a massive extent. So we got a taste, but we've kind of moved past it. We're now all in on AI, all worried about the Iran war, and everybody's kind of forgotten about it. But just for, context, China controls 90% of the world's rare earth element refined capacity. 90%. And that's just rare earth elements. Nickel as well is around 60%. Manganese, another critical metal when it comes to battery tech, 90%. Lithium, 75%. Cobalt, 80%. So when you're looking at that across the entire, this critical metal space, there is a massive amount of geographic concentration. And then when you talk, bring it back to that earlier point where we're talking about how the world is starting to deglobalize and the supply chains can no longer be relied upon in the same way as before, suddenly you have to basically understand that this is something that all nation states and all institutions around the world have to really invest in to diversify away from.
Well, the geopolitical risk for that is huge.
It's huge. It's huge. And that concentration is massive. And the second thing is that the time frame to invest away from these critical metals and rare earth elements is going to be a very, very long, multi-decade story.
Can we even build the mines, get them out of the ground to produce in any sort of reasonable time frame? Because if you've got 90% of the market like China does, how do you compete with that?
I think that comes to the second part of that concern that I think investors aren't truly grasping. Because when I talk about rare earth elements and critical metals, a lot of investors immediately go like, "Oh, we'll go invest in Linus. We'll go invest in another rare earth name that is based in Australia or based in the US, MP Materials, for example." And I think, yes, these names are likely to benefit from government support and policy. But if you really want to invest in the end goal, which is the increasing demand for rare earth elements over time in defense tech, in robotics, in EVs, in clean energy, you have to invest in these Asian equity names, these Chinese equity names. And I know that that is unpalatable, but because what we just talked about, these supply chains were built over 30 years. So in 1992, Deng Xiaoping, which was the then leader of China at the time, had this famous quote, which was, "Middle East has oil, China has rare earths." And that was basically the beginning of them to start building out that supply chain. It took them around 18 years to start, finally having a grasp of the rare earth elements supply chain to be able to exert some pressure on the global stage. In 2010, they had a dispute with Japan. And now, 30 years later, they have a firm grasp on the rare earth element supply chain.
I would say it's more than a firm grasp.
Yeah, it's a very, very firm grasp. Yeah. And you have to think about the fact that China, the way that it is, it's authoritarian. It is a one-party nation. They basically, if they say they want to do something, there's no one that really stands in their way. And then you have to think about the democratic countries around the world that now want to nearshore or bring these supplies back at home, often with a lot of climate change protests and these, because refining rare earth is a very dirty task. And then these laws and these legalities that they have to go through, it's going to take way longer than 20 years.
Can they even do it?
I think it's not a matter of can, it's a matter of, they have to. Because they simply cannot rely on China in the long term. So this is something that they will probably push through by means of necessity over the next 10, 15, 20 years. And
but some of those mines, so just come back to the ESG, sustainability, environmental laws of Australia's got plenty, and most Western countries do too.
Yeah.
The I wouldn't say environmental destruction, but when you run those mines, they can be quite destructive.
Yes.
Those, correct me if I'm wrong, but the environmental laws would have to change because you just couldn't run those mines in Australia, for example, now. It just wouldn't be feasible.
Absolutely. And I think that is something that will eventually, I think I'll leave that up to the politicians.
It's a rock and a hard place.
Exactly. It's definitely a rock and a hard place. But it's something that has to be done. And I think a lot of these nation states do recognize that, whether that is bringing it, actually back home and doing it in your backyard, or relying on a friend to do it. Perhaps, the US can rely on Canada or Mexico or Australia. So from that perspective, I'm not really wondering about if they will do it. I know they will do it. It's just of the time frame within which they can actually achieve that.
And what price
And at what price.
people in general are willing to pay to do it.
Exactly. And the end goal, or actually the end point that I was trying to make, is that for now, if you want to invest in rare earth elements and this critical metal space, you really can't avoid that Chinese equity exposure, because if you don't invest in that part of the world, you're not getting a true to label exposure. You're just investing in the dredges or the very small players of the world. So I would say, number one, be aware that yes, the ex-China exposures around the world are likely to benefit from policy support and governments and institutional investment, but also you have to spread out your exposure and diversify into those Chinese equities if you actually want to access the end material and those end commodities. And that's what our fund, the Global X Rare Earth Elements and Critical Metals ETF, under the tick code GMTL, invests in. It invests across both Chinese equities and the rest of the world, across the entire supply chain.
And if we were to look at commodities from a slight change of pace from an investor's point of view,
Yes.
what do you think are the sort of maybe the one or two things that investors don't understand? So the things that you have to correct them on in terms of their understanding of the commodities markets.
I think there's one that I would really highlight, is a lack of understanding of just how perfect the ETF vehicle is when it comes to investing in targeted commodity miner exposures. So this is a very, very niche subject, but it's something that I really like to highlight. So for example, a lot of investors think about investing, once again, I'll talk about the copper miners because it's such a topical product. When they think about investing in our wire ETF, they think, oh, it's just like investing in one big copper miner. But no, really, it's not that. It's closer to investing in the physical commodity itself, because let's say investor A invests in Ivanhoe Mines, which is one of the biggest copper miners in the world. One of their assets, for example, Kamoa-Kakula, goes through a seismic activity and the entire facility is destroyed. This is obviously an extreme scenario.
Yep.
But then Ivanhoe Mines is going to crater in terms of its valuation, because obviously it's not going to produce any more copper anymore from this massive, massive mine. But globally, the copper price has actually just gone up because it just saw a supply disruption and supply and demand.
Yep.
Exactly.
Yep.
And in terms of the ETF, the way that it invests in multiple miners and lots of miners that are targeting copper, the rest of the basket, excluding Ivanhoe Mines, just saw their profit margins tick up.
Yeah.
So the copper miner ETF is actually outperforming, even though Ivanhoe Mines has just had a catastrophic event. So I think a lot of investors are not aware of just to what extent our ETF can diversify away that idiosyncratic risk and completely remove that element from investing in commodity miners, which is really quite a big risk when you talk about gold miners, silver miners, anything. If you don't understand the assets, if you don't understand their management team, that is something you have to be concerned about.
Yep. But that's a very good, very interesting example.
Yeah.
Because if you were investing in maybe into the entities or the stocks themselves, you would be completely exposed.
Easily wiped out.
Yes, you would. So it's a diversification and risk play, right? It's sort of managing your exposure, so your upside offsets your downside.
Yeah, exactly. Yeah.
So just over the sort of we've kind of touched on this a little bit over as we look forward. Are there any particular sort of thematics or things that you think investors need to keep their eye on? We've kind of maybe touched on a couple of them.
Yes.
But the trends, what trends should investors be looking at carefully?
I think broadly, if we're talking about trends, there's the rare earth element and critical metal story, but we've already talked a lot about that.
Well, I'm just going to lock in your 90%,
Yes.
90% of the market sitting in
China, essentially. So that is a very big story. And I would really emphasize that that is probably one of the most bullish categories that within the commodity space.
Nobody's giving up their phone.
Exactly. And then outside of that, I think an interesting story that has been popping up a lot more now is the trend of EVs and their adoption kind of re-accelerating after kind of slowing down in 2023 and 2024. And the story there is after the Iran war, it has now been twice in the past 5 years in which we've seen, a conflict kind of on the other side of the world affect the viability of our mode of transport back at home. And a lot of kind of consumers, they're thinking about EVs now less of a clean energy, saving the world type of play, but more as a financial hedge against the volatility in the fuel markets. So this is something I think a lot of investors are not really picking up, and the extent to which this new energy story is impacting, consumer sentiment and consumer adoption in terms of EVs, and not just EVs, but like battery technology, solar panels leading into battery systems back at home.
All of which require rare earth minerals.
Rare earth elements and lithium as well, and lithium to a massive degree. And I think the lithium story is something that is a little bit underappreciated because a lot of investors rode the high of 2020 to 2021. They saw the massive, massive heights that that lithium really reached back at home, Pilbara, your Lion Towns, and only recently have they started to come back. And a lot of investors, after being burnt that first time, they're like a cat having jumped on the barbecue. They don't want to go anywhere near the thing. But I think they could potentially be missing out on this second wave, this second renaissance of EVs adoption.
Well, Justin, that's been fascinating. And thank you very much for your insights into commodities. Some great little tidbits there for the investors to think about. Thank you very much for your time today.
Thank you.
If you like what you saw, what you heard, please subscribe, share, or follow. Leave a comment on the channel of your choice. And for more insights like this, and to search, find, and compare hundreds of investment products, like all of the global ETFs, please go to investmentmarkets.com.au.